Okay, so it's Sunday, February 15th, 2026. And if you've dared to look at your portfolio this morning, you might be feeling a specific kind of whiplash.
Oh, absolutely. It's that feeling of extreme contradiction, isn't it?
It is. It's where your phone screen is just this sea of red, but then you look up and the headlines on TV are, I don't know, throwing a ticker tape parade.
A massive divergence. We're seeing it between the whole macroeconomic narrative and what's actually happening in crypto.
Exactly. I mean, on one side, you've got these prominent voices like David Sachs, basically taking a victory lap. He's screaming from the rooftops that the U.S. economy is in a boom phase.
Talking about GDP accelerating, productivity just skyrocketing.
Right. But then I open up this stack of reports we have for today, especially, the analysis from investing.com, and it paints a picture of a market that is just, well, completely stuck in the mud.
Stuck in the mud is putting it politely. I mean, Bitcoin is down nearly 45% from the highs of late 2025. Liquidity has just vanished.
The sentiment is exhausted.
It's not just bearish, it's tired.
So that, right there, that's the mission for this deep dive. We have to reconcile these two realities. Is crypto dead, again, or is this just the messy middle part of it growing up?
And we've got a great stack of sources to work with. Outlook reports for 2026 from Coinbase, Fidelity, 21 shares.
And Valtoti. We're going to look past the price charts and get into the structural shifts, the plumbing, if you will.
And that's the key, because if you only look at price, you miss the revolution happening under the hood. We're talking about the death of the four-year cycle, this new thing called agentic finance, and believe it or not, the return of the ICO.
So, okay, let's unpack that. Let's start with the macro clash, boom or bust, because frankly, that David Sachs tweet from yesterday feels like it's describing a different planet than the one crypto Twitter is on.
It really does. Sachs is arguing the U.S. economy isn't slowing down at all. He thinks it's reaccelerating. He's projecting GDP growth hitting, what, 4 to 5%?
Which is just, I mean, that's massive for a developed economy.
And his main argument comes down to one word: CapEx, capital expenditure. He's looking at the hyperscalers. So Google, Microsoft, Meta, Amazon, they're spending roughly $600 billion on AI infrastructure.
Let's just pause on that number. 600 billion, that's larger than the GDP of most countries.
Exactly. You don't spend that kind of money just to build a slightly better chatbot. This is a fundamental infrastructure build-out.
It's a new industrial revolution.
It is. And Sachs' point is that this capital, it doesn't just disappear. It circulates. And when you have that kind of innovation-led growth risk appetite, well, it eventually expands. Capital rotates.
It starts in the safe bets, the NVIDIAs of the world, and then it flows downhill into other growth assets.
Like Bitcoin.
And the Coinbase outlook, it actually backs this up with a really interesting historical parallel. They aren't comparing 2026 to 1999.
No, not the dot-com bubble bursting.
Oh, they're comparing it to 1996.
Which is such a crucial distinction. 1999 was the end of the party.
Yeah.
1996 was that, messy phase right before the real explosion.
The internet was clunky, it was slow.
But the infrastructure was being laid. Coinbase sees the U.S. economy as resilient now. The soft landing we all worried about for 3 years. It happened. And now we're taxing for takeoff.
Okay, that's the sunny side of the street. But we have to talk about the storm clouds, because they are right overhead. Investing.com dropped a report a few days ago that was, well, it was bleak.
A sideways slide.
Yes. They're highlighting that Bitcoin is down, sure, but more importantly, they're talking about the October 2025 crash. And I think for a lot of our listeners, that wound is still pretty fresh.
It completely shattered confidence because you have to remember, unlike previous dips where maybe one bad actor like FTX blew up, this was a broad liquidity crunch. It dragged everything down.
And the retail investors, the tourists, they got burned badly.
And they haven't come back. Not yet. Ray Youssef, the CEO of Noons, he calls this a protracted reassessment of risks. He's explicitly saying, no V-shaped recovery is coming.
He thinks we're going sideways until when? The summer.
Summer of 2026.
Wow. That is a long time to wait when you're down 45%. And the irony here is that the suits, the institutional investors, we spent years begging to get in the market.
They're the ones holding the price down now.
How does that work?
It's the downside of institutionalization. They don't have diamond hands. They have risk models. So when their tech stocks go up, they rebalance. They sell their crypto winners. They're treating Bitcoin like a mature asset.
Selling into strength to balance their books.
Exactly. Which, leads perfectly into this third theory from the 21 shares report, which honestly I find the most fascinating. The idea that the cycle itself is broken.
4-year cycle.
Yeah, for the last 12 years, it's been our religion, right? The halving happens, supply gets cut, price goes parabolic, then we crash 80%. Rinse, repeat.
You could set your watch to it.
And 21 Shares is saying that clock is broken. The volatility is compressing. Look at the drawdowns. A bear market used to mean an 80% drop. Now, we're seeing 30, maybe 40%.
So crypto is becoming boring.
Or mature. Fidelity Report calls it a potential supercycle, but I just think of it as stabilization. Bitcoin is behaving less like a volatile lottery ticket.
And more like a global macro hedge. More like gold.
Exactly. And if it's acting like gold, that brings us to the biggest gold buyer in the room, the government.
The institutional takeover. This is huge. The Fidelity Report highlights something that still feels surreal to say out loud.
The executive order.
March 2025. President Trump signs an order establishing a strategic Bitcoin reserve for the United States.
That was the watershed moment. It did two things. First, it legitimized crypto as a store of value at the federal level. Period.
You can't call it magic internet money anymore if the U.S. Treasury is holding it on their balance sheet.
Not next to gold bars and foreign currencies, no. And second,
Game theory.
it triggered game theory. We're seeing now in the reports. Kyrgyzstan passed a bill. Brazil, Pakistan, the Czech Republic. They're all exploring reserves.
It's geopolitical FOMO. If the U.S. holds it, you feel like you have to hold it too.
It's an arms race for assets. But it's not just governments. The corporate world is diving in. And I kept seeing this acronym in the reports, DATS,
Digital Asset Treasury.
which is basically the MicroStrategy model going viral.
Michael Saylor really was just the first penguin off the iceberg, wasn't he?
He was. And now the prediction from 21 Shares is that these DATS will hold over $250 billion in assets by the end of 2026. But here's the real shift.
It's not just Bitcoin anymore.
It's not. Companies are holding Ethereum and Solana on their balance sheets.
Why? Just for diversification.
It's about yield.
Huh.
Staking. If you're a company with $100 million in cash, you can leave it in a bank account earning maybe 2%, or you can hold staked Ethereum and potentially earn 4 or 5%.
So it turns the corporate treasury from a boring storage closet into an active profit center.
Precisely.
That makes so much sense. But speaking of massive numbers, the stat that really stopped me cold was in that 21 Shares report about ETFs.
Oh yeah, it's a bold call. They believe global crypto ETPs, that's exchange-traded products, are on track to surpass $400 billion in assets.
Okay, let's just contextualize that for everyone listening.
That would make the crypto ETP market larger than the QQQ.
Pause on that. The QQQ, the NASDAQ 100 ETF, that's the engine of the U.S. stock market. It holds Apple, Microsoft, NVIDIA. You're saying a basket of crypto is on track to be bigger than that?
It sounds insane, but look at the demographics. For anyone under 40, savings isn't just a bank account anymore. It's a crypto ETF. It's in their 401ks. Their financial advisors are pushing it. The friction is just gone.
So the suits have bought the asset. Let's look at how the network is actually being used then. Let's talk plumbing, because while prices are sideways, the use of stablecoins is just exploding.
Stablecoins are the unsung heroes. They don't go to the moon, so people ignore them. But Coinbase calls them the killer app.
And the prediction is supply reaching $1 trillion by the end of 2026.
Correct. But the really interesting part isn't just the volume. It's the type of stablecoin. We're seeing this huge shift to yield-bearing stablecoins.
Like USD or USD. Okay, break this down, because this feels like a direct shot at traditional banking. How does that work?
Well, think about how a bank works. You give them your dollar. They turn around and invest that dollar in, say, U.S. Treasury bills, which pay 5%. The bank then gives you maybe 0.5% interest and keeps the rest.
Well, they keep the spread.
That's their business model.
Right.
Yield-bearing stablecoins just destroy that. They take your dollar, put it in the same treasury bill, but they pass almost all of the yield directly to you.
It democratizes the Fed's interest rate.
It's a better dollar. Why would you keep money in a bank earning pennies when the digital version pays you the full market rate?
That's the aha moment. And this one sector is projected to be $50 billion plus. Which brings us to the other big buzzword, tokenization. RWA real-world assets.
Yeah, we've been hearing tokenization is coming for 5 years now. But 2026 really seems to be the year the dam breaks. Voltoti and 21 Shares are projecting over $500 billion in total value locked.
$500 billion. But let's get specific. I get tokenizing a building, but the report mentions pre-IPO equity.
This is a game changer for the average investor.
So this is like what, buying shares of a company before it goes public?
Yes. Normally, if you wanted to buy shares in a private unicorn, say OpenAI or SpaceX, you couldn't. You had to be an accredited investor with millions in the bank.
And the right connections.
Right. Tokenization lets those shares be put on the blockchain. So you could literally buy $100 worth of SpaceX on-chain, just like you buy Bitcoin.
That is blurring the lines. It's merging Wall Street with crypto until the distinction is almost irrelevant.
And with the Clarity Act, anticipated for 2026, which would let banks legally custody these tokens, the gates are swinging wide open.
Okay, so we've got the macro confusion, institutional adoption, and the plumbing. Now I want to get to the part of the report that felt like I was reading a sci-fi novel, the frontier, specifically this agentic economy.
This is my absolute favorite part of the 2026 outlook. It is the convergence of AI and crypto.
So we're talking about AI agents, these autonomous bots. But explain the problem they have right now.
Well, imagine you have a super smart AI assistant. It can plan your whole vacation, find flights, hotels. But
it can't pay for anything.
it can't pay for anything. It doesn't have a bank account. It doesn't have a social security number. It needs a way to pay for things natively on the internet.
And that's where crypto comes in.
That's where crypto comes in. Coinbase has this protocol they're pushing called Buy 402.
Buy 402 sounds like a Star Wars droid.
It's actually a nod to an old HTTP error code 402 payment required. It's designed to let machines pay machines instantly.
So paint a picture for me. What does that look like in practice?
Okay, so you're asleep. Your AI agent sees a flight price drop for that trip you wanted. It instantly pays the airline's agent. Then it realizes it needs more data to analyze hotel reviews, so it pays a data provider. We're talking fractions of a cent to access a premium database. Then it books the hotel.
All peer-to-peer.
Machine to machine, settling instantly on the blockchain. Robots paying robots while you sleep.
That's both incredibly cool and vaguely terrifying. And you can invest in it.
Yep. There are agentic strategies emerging. Platforms like Infinite or Giza, where you're essentially investing in a hedge fund run by an algorithm that operates 24/7 on-chain.
Speaking of algorithms knowing the future, let's touch on prediction markets. Polymarket, Kalshi, these things are huge.
Exploding. The projection is $100 billion in volume by 2026. But the shift is philosophical. They're becoming the source of truth.
I've seen that. X and Google are integrating the odds directly into their search feeds now.
Right. If you want to know who's going to win an election, you don't look at a poll anymore. You look at the betting markets. It's the wisdom of the crowd, but backed by real money. It's less gambling and more financial intelligence.
Putting your money where your mouth is. Now, there's one more thing in this frontier section that surprised me because I thought it was dead and buried. The ICO.
I know. Just saying the letters ICO sends a shiver down the spine of anyone who survived 2017.
I remember the scams, the white papers that were just stock photos, but they're back.
But legal this time. Regulated.
Yeah.
Platforms like Echo and Legion, they do full KYC checks on everyone. It's the IPO model, but for digital assets.
And it's working.
Well, the report mentioned one sale monad on Coinbase that raised $216 million from 86,000 buyers. That's not a niche experiment. That's a massive capital raise.
It sounds like the Wild West is finally getting paved over.
Or at least getting some traffic lights.
Which brings us to the roads themselves, the infrastructure, Ethereum. We keep hearing about the surge and blobs. What is actually happening with the tech in 2026?
The reports from KuCoin and 21 Shares break this down well. Ethereum is in its surge phase, and the goal is 100,000 transactions per second.
100,000. For context, Visa handles way less than that on average, so that's global scale. How do blobs get us there?
Okay, here's the analogy. Imagine a highway is Ethereum layer 1. Before, every transaction was a separate car on that highway. It caused huge traffic jams.
And expensive tolls. I remember the $50 gas fees.
Oh yeah. Blobs, or proto-dank sharding, are like introducing a massive bus system. You bundle thousands of transactions into one blob, one bus, and send it down the highway once.
It compresses the data.
And makes the ride incredibly cheap. But while the highway is getting more efficient, the report also mentions a bloodbath for layer 2s.
Those are the networks built on top of Ethereum, right?
Yes, and 21 Shares predicts most of them will fail. We're going to see a lot of zombie chains.
What's a zombie chain?
Think of those ghost cities in China.
Yeah.
You know, huge skyscrapers, perfect roads, billions in infrastructure, and nobody lives there.
No users, no transactions.
That's the fate for 90% of these chains.
So who are the winners?
The giants.
Yes.
Base, which is Coinbase's chain. Arbitrum. Optimism. The consolidation is going to be ruthless. But for the end user, It's great news. Transaction fees on these winning chains are dropping to fractions of a cent.
And that low cost, bringing it full circle, is what makes that whole agentic economy possible.
Exactly. And AI can't pay a $5 fee to buy a 10-cent piece of data. If fees are $5, the AI economy is dead. If fees are a tenth of a cent, it thrives.
So let's zoom out. We've hit the macro confusion, the institutional game theory, the disruption of banking, the AI frontier, the infrastructure. What does this all mean for the listener staring at their red portfolio today on February 15th, 2026?
I think if I had to synthesize all these reports into one idea, it's this. The casino era of crypto is fading. The utility era is here.
It's just becoming normal.
It is. 2026 isn't about that wild, speculative to-the-moon energy of 2021. It's about integration. It's in your 401k. It's settling your Visa payment in the background. It's the currency your AI assistant is using.
It reminds me of the internet in the early 2000s. We stopped talking about going online.
We just started living online. It's the perfect analogy. And that leads to a final provocative thought for everyone listening.
Lay it on us.
If that 4-year cycle is truly dead, and that heart-stopping volatility is dying with it, are we ready for crypto to be boring? Are we ready for it to be just another asset class like gold or tech stocks that just grows steadily over decades?
I think a lot of people might miss the adrenaline of the casino.
They might. But here's the flip side. As the price action gets boring, the world built on top of crypto, the AI agents, the tokenized SpaceX shares, the prediction markets is about to get weirder than any of us can possibly imagine.
The money gets boring so the technology can get crazy.
The weirdness is just getting started.
I love it. Look past the ticker, folks. Look at the pipes. Thanks for diving deep with us today.
Always a pleasure.